I know, I'm late. How you doing, friends? This is the Zero DTE final hour show. And the reason why I'm late is that I was performing, I guess performing would be the right word, or conducting an orientation meeting for new members, many new members of the service and of the Zero DTE, 0 Days to Expiration service, which is a coaching and a mentoring service. And there's a 4-week trial. The 4-week trial, you're going to learn more in that 4 weeks than you ever thought possible. But I did this for new members so that they would get a head start on all the things that are available and how to take best advantage of that service. So, like as I said, a coaching and mentoring service for an incredibly affordable price. There's no reason why you shouldn't be doing this. I'm going to teach you how to be a professional trader. I'm going to teach you the secrets of pros. I was an institutional trader, hedge fund manager. I've been involved in this industry for 30 years. I can show you exactly what the pros do and how it's different and why they make money and you don't. So go to the link below, sign up for the 4-week trial, and you'll be very happy that you did. All right. And don't worry for those things that said that you missed it. Not a problem. The session is recorded, and I'll have it up there. You can also sign up for a future session. They're held every week. All right. So no worries. All right. So the purpose of the show really is to find what are the best strategies for Zero DTE. I did this show last year and I committed to 100 episodes where we would look at trading on the final hour of the market, starting from 3 o'clock to 4 o'clock and seeing if we could make hay of it. And by and large, it was successful, but it was laborious. And we didn't find like a really strong edge. There was an edge, but not a real strong edge. So we decided, we're not going to do that final hour thing. What we were doing right now seems perfectly fine. Let's stick with that. But, along the way, and now that this service is about 2.5 years old, we're finding that there are a lot of different variations that seem to work. And things that we want to explore as well. In fact, part of our of being a professional trader is to have a constant background process that's going where you're always looking for new strategies. And so that process has to have some credibility to it. It has to have some structure to it so that you're doing the right thing, that you're examining everything that you can about that. Because if you're going to commit money, your money, to a process, you want to make sure that it's going to have a chance to make something of itself, I mean, why else would you do that? You have to have reverence for your money, right? So that's what we do. We're doing this as that alternative process that we're going to sit here and figure out what strategies we can employ, and we're going to apply rigor to them and trade them. And so you can follow along, and there's going to be a whole number of different strategies that I'll look at. I'm in the process right now. These first 3 shows that I've done this week is just sort of laying the whole groundwork of how this is going to work. And the first show on Monday, if you go back there, you'll see that I laid out what the high-level process was. And so I can, you know what I can do? I can show you the basics of that right now. Let's see if I can find that. Yeah, there it is. Give me a second here, and I will... now, this is a process that I used when I was developing automated strategies. And so I know it works because it worked for me. I developed hundreds or even thousands of strategies, of which many of them were put into place to trade hundreds of millions of dollars. So I know it works. I don't know who that person is. use, but we'll say we'll call you later. All right. Where was I? Oh yeah, the getting this thing up and running. Almost there. Secondary display. There we go. All right, this is the entire presentation that I used to teach people how to create automated strategies, but we're going to go to the page that's most important. But wouldn't you like to have an equity curve that looked like that? Of course you would. What does it take? Figuring out a hedge fund, that's what this is, figuring out a hedge fund and correlations. Or an equity curve like that. Right? Well, this one had these assets or asset types, and these were all seasonality type of strategies, and they had we were looking for highly uncorrelated strategies to match to one another. But anyways, the process that you use to find strategies is pretty complex. Now, you look at this and it looks very colorful, looks like a kid did it, right? But this is actually just the high-level veneer of what is a very complex process. First, there's the idea stage. That's the head here with the gears. And when you have ideas, you throw it into development. You develop what the overall strategy is going to look like. And some of them will be harebrained, and you throw it into the bit bucket, and others will be worthwhile pursuing, and so we throw it into the curation cycle. And you can see that all these ideas that now have taken on a little bit more life, as you can see, because they have color, right? And every once in a while, after that curation cycle, and you're running them in simulation mode, and some of them stand out above all the others, and they drop down here like they're going to be born. And if they drop down far enough, you say, okay, they will be born, and I'll put them into a live campaign where I'm going to put real money to them. And this is all of what we're going to do. Now, strategies, not all strategies are appropriate across every market type. And some strategies will last, others will be flashes in the pan. Some will have medium strength, some will have strong strength, some will be lasting, etc. Some of those will go out of favor, and if they do, then they come up here and we decide, do we want to kill them or put them back into curation? Maybe they just need to go back, go back to and wait for the right market conditions for them to run. And by having them in curation and running them in simulation all the time, then we can tell if they're coming back into their sweet spot. And then maybe they'll drop down and get born again. Strategy gets born again. So anyways, each of these circles, these big circles, has a process associated with it. So I'm going to show you quickly what those are. So you have the development cycle and all the different aspects of developing a strategy and what you need to do to go around that. You have the curation cycle, and this is while it's in that, what you're looking for, how you size it correctly, how you decide how to balance it across those, what's the correlation between each of the strategies, etc. How do you monitor it? And then finally deployment. You want to have all of that stuff up front. What group of strategy is it in? That's very important. And then there's finally the campaign itself, and that's when you deploy it into that campaign, and then you monitor that campaign, and you're either collecting profit from it or you're not. So that's the strategy life cycle, and that's what we'll essentially be doing here on in. But the first thing is that we need to start talking about the different strategies and get people involved, get them to put up their ideas, come up with a list of these strategies that we're going to look at. I will take a periodic look at different strategies. All right, Marco's asking, are you teaching implementation into a Python-based environment? No, we're not creating automated strategies. So let me be clear on that. Our purpose here isn't to create automated strategies. I'm using the automated strategy lifecycle framework because it works whether you're doing automated strategies or you're doing discretionary strategies. We're doing discretionary strategies that we can trade with 0 DTE. That's the focus. All right? So put on your blinders. This is what we're looking at, nothing else. Discretionary strategies for 0 DTE for the average person that they can do without computer assistance. So that's the world of strategies that we'll be looking at. So today I wanted to take a closer look at, I don't know if I'll be able to do this. Let's see here. I don't know if my iPad still has juice in it. I hope it does. It'd be a shame if it doesn't. Oh, it does. Thank God. So today we will look at the Iron Condor. And it'll be one of the strategies that we look at. We'll use it as a kind of a control group because that is probably the most popular strategy that's being used with 0 DTE. And the way it's used, and we'll also look at alternate uses of it. Some of the alternate uses go way beyond what most people are doing. And that includes something that many people have pounded me about, wanted me to, do more about it. And that's something called the dynamic squeeze, which is really a strategy that's built around something called delta neutrality, and that is trying to keep price right in the center of your strategy for the purpose of collecting premium on 0 DTE. And you can do that with the Iron Condor. Now, what is the Iron Condor? The Iron Condor, let's go to the iPad. All right, so we have to change the display settings. I don't know why I have to keep on doing that, but I have to keep on doing that for some reason. So I'm going to show everything that I do when I'm talking about strategies is in terms of looking at the risk graph, right? And when we start getting into the weeds of them, then we'll start looking at options chains and stuff like that, but we don't have to do that right now. We will hardly ever, if we can avoid it, be looking at the Greeks. There may be some usefulness in doing these delta neutral strategies and looking at the Greeks just as a dashboard measure to figure how much further that we have to go and figure out what the potential is for the remainder of the day and then calculate out what will be an optimal time to take profit, that sort of thing. But we won't look at the stuff except for from a conceptual point of view. For instance, I won't be examining gamma risk too closely, other than to recognize that, there's high gamma or there's low gamma risk, right? Because as a discretionary trader, you're not going to sit there and do all these calculations in your head as if they're going to make a material difference while the market's moving all over the place, as if that's going to make a difference in the way you want to know basically what you want to do, if this happens or that happens. All right. So anyways, an Iron Condor is made up of two short verticals, a short call vertical that is placed above the market like this, and a short put vertical. All right, now each one of these verticals will have a width to them. It's going to be a spread. It'll be, I don't know, between 5 and 30 wide, from here to here. Same thing over here. And then you'll place them apart from one another, some distance. And typically, the way people do it is they choose a delta. And so they'll place the spread based on the delta of the spread. And so they'll choose like usually between a 5 and a 15 delta. Now, basically, that means that that's anywhere from a 95% to an 85% probability of profiting. And they'll do the same thing over here. And so when they put on a trade like that, let's say a 5 delta, you'll result in a zero line. The profit line will be somewhere up here. That's the zero line. Everything below it is in the red. Everything above it is in the green. So let's also connect this up, right? So everything above it will be profit. This is where, if you land in here, this will be profit. If you land below, you won't be in profit. So the other thing that we need to keep track of is the real-time profit. So presumably when you get into this trade, you're going to put it on at the money. And this is called a market neutral trade. You put it on both sides, and what you're banking on is that price will stay inside of these wings. And the profit curve, the real-time profit curve, when you first get in, will look like this. And then slowly it will grow in this direction. And you can see it doesn't have very far to go to fill up once it gets to the top of this fly, there's no more growth for it to go. But eventually it will take on the shape of this whole structure. Eventually. But that'll take all day, right? And so here's the other problem here. Let's give this a value of 1. If I gave that a value of 1, that's the potential profit or premium that you're going to collect. And then down here, this will be a 10 or more, right? And so that's all risk. So you're putting up $1,000 to make $100. Now, the way this strategy works, and because of the peculiar nature of it, you'll notice that if price goes this way, you start riding down this profit curve. So if price ends up right here, now you're sitting right here. And if you look over here, you're in negative territory, maybe minus $300 or something like that. If you go too far and go outside of the wings, you could potentially lose $1,000. So that's a problem. First of all, this extreme, this slope of this curve here is called your gamma risk. Of course, when you're sitting right at the top, there's no gamma risk because price isn't moving, and your value is only going up as it decays. But it takes all day for that to decay. You know, that's for 6.5 hours it takes to go from here to here to make that $100. Well, the chances of you just staying right there are extremely small. Much greater chance that you're going to move to the left or to the right and go into an immediate negative, or I guess an unrealized loss. Now, one might say, well, you know, if I go down this, I could hang on and it could just stay there and then come up and make me money. As a matter of fact, at the beginning, I had a 95% probability or an 85% probability that would happen. But as soon as it starts moving this way, and you know in the markets that there's usually a big move like that, when it moves that way, you no longer have a 95% probability of winning. In fact, your probability of winning has just dropped dramatically. On top of that, you're underwater. Right? That's the reality of this thing. And for that reason, people who trade this strategy put a whole bunch of constraints on it that kind of dummy it up. One of the constraints that they'll do is they'll say, okay, I'm going to put stops so that if it goes too far this way, my stop is going to be right there. Or if it goes too far this way, my stop is going to be right there. And so typically they'll make that stop 3 times the max potential profit, which essentially is like cutting this off right there and right there. So now you can only go from here to here. You have to stay between there and there. What is that doing? Well, effectively, that's taking it from being a 95% probability trade to one that is lower, maybe 70% probability trade with stops, meaning that if you hit the stop, you're out of the trade. You automatically lose. Unlike if you didn't have stops, there's no getting out of the trade until you get to expiration. There's no coming back. Once you're out, you're out. So if you had like a defined risk on some other trade in an options play that doesn't have stops, you could hit the max loss, but then it could come back. You don't get out of the trade. You still have a chance. Here, you have no chance. You hit that stop. You are done. Finito. Gone. That's it. So that's one constraint they put on it. The other constraint they put on it is that once this profit curve grows enough so it gets 50%, they consider that a win, and then they get out immediately. They take it at a 50%. Now, if you think about that, what you've really done, if you turned a 95% probability trade and a risk reward of 10 to 1 and turned it into a 20 to 1 probability trade, from 10 to 1 to 20 to 1. Then on top of that, you've reduced the chances of you getting that 50% by putting on the stops. So you've changed the whole thing. You know, the initial appeal of this is that, oh, I've got a 95% probability trade, but I'm going to take half of the potential profit, and I'm going to take way more risk that I'm going to get stopped out. That's what you're doing. It is a total Frankenstein of a strategy. People will tell you, oh, all you have to do is just manage it. Manage your risk. Put stops on an options trade, which is sacrosanct. That is just unbelievable that anybody would ever imagine to put stops on an options trade. Why have options in the first place? They are designed to have managed and defined risk. Why not just exit the trade, break even? You're assuming holding to... No, I'm not. I'm not assuming holding to expiration at all. In fact, everything that I've shown you here is getting out way before expiration. That's why they create these other rules with this strategy. If they had the balls to hold it to expiration, they might do a little bit better, but they get out way before expiration because they hit these stops or they hit these profit targets where they know that if they don't get out then, they risk peril. That is the whole reason why I'm talking about this. Now, holding to expiration isn't any big deal because if you hold on to it and it achieves what will happen, the maximum loss, you're going to lose 10 times what you put up, wiping out weeks of profits. And there's nothing to say that you can't hit 2 or 3 losses in a row, which could happen. It's happened to me before. For these type of high probability trades. I've even had higher probability trades where I've hit 2 99.9% probability 3.5 standard deviation trades and lost in the same week. It'll happen. It's a statistical certainty that it will happen eventually. That's exactly right, Marco. You destroy your positive expectancy. First of all, there is no positive expectancy. There is long-term negative expectancy with the stops. Because it is a high probability trade, it therefore has negative expectancy. But what little you have of that, you destroy it even more with the stops. That's how bad this strategy is. Now, there are other things that you can do. There are other things that you can do. You can push these things out of the money. That might be an alternative, and change the whole risk to reward equation. But we can do that same thing with butterflies. But we'll explore that. We'll explore how we can trade this iron butterfly. But we'll also explore another type of trade that is called the dynamic squeeze. And the dynamic squeeze is a way that you have a completely and continuously variable iron condor that may eventually turn into a butterfly. All right, Tremaine says, I don't do pit stops for that reason. Invariably, you get stopped out when it swings. Yeah, it doesn't make any sense. But in that case, you also can't stop the defined risk that you have, which is tremendous. Charles says, super out of the money iron condors seem like a super safe bet. Yeah, I like those in the same way that I like a super OTM long butterflies. No, they don't need crazy outliers. That's where people are mistaken. I trade every day with super out of the money butterflies with asymmetric risk, 1 to 10 every day, and make fantastic money. Does not need a crazy outlier move, just needs average moves. And then the crazy outlier moves make you unbelievable money. That's the difference. So the other type of trade that we're going to look at that's similar to this is I'll call it the dynamic squeeze. And let's see if we can describe the dynamic squeeze. So you might start with a fly, right? So you put on, a vertical. You put on a nice wide vertical. And then you wait to see what happens with price. Does it go into the vertical? Does it go into the vertical? Or does it go away from the vertical? So if it goes away from the vertical, that's good. What you can do then is you can put up another vertical. Or you can do that to start with. Let's say that you started with two verticals. Let's say it goes this way. Now, that's bad for this one and good for this one. So it's bad for this one, good for this one. Because you're going deeper into the money because the profit curve looks like this. And so as you're going this way, you're going up that profit curve. When you're going this way, you're going up that profit curve. If you do that, you could take this one here and lock in that profit that it's made and then roll it closer. So like, let's say price now is right here. Why does that keep on happening? Let's say price ends up right here. Stop that. Wow. No matter what I do. Let's see. Price ends up right there. So this vertical has benefited from it because you've gone deeper into it. So what you can do is you can roll it closer. Must be my finger. You can roll it to here, and then it will be up here, like that. And then collect more credit. So you lock in the profit that you made from this guy here, and then collect more credit from this one, which would raise both of these flies up by some amount because of the extra credit that you've created, and you've locked in profit. And then if it moves this way, you could then roll this one in the same manner that way. Well, it's how you roll and when you roll in this particular case, Charles, that will make the difference. And then there are rules around how you would do that, where you can only roll under certain conditions. And when you do it only a certain amount when you can collect a certain amount. And then you can control and try to keep this. Now, eventually, this is going to end up into a strategy that will look like this if everything goes perfectly. And you've already collected hundreds of dollars of profit, and you're sitting with a free butterfly right in the center, and hopefully near the end of the day. That would be ideal for this strategy. It's hard to attain. That's probably a low probability situation, but there are many other situations where you can get out with either small profit or very large profit or tremendous profit with a little bit of manipulation or adjustments. The key here is to not adjust too early and not to adjust too much. There are other ways that you could manage this trade through something called gamma hedging. So let's assume that you have this trade on. Let's make it a fly, a butterfly. And we have some profit in it. Maybe that profit looks like this. Now, you started off here, and let's say that we moved into the fly. We're right here. We're right inside the fly. And while we moved into it, subsequently the profit got bigger, like that. That's a good situation. That happens every once in a while. But you're worried because you're sitting right here. You're worried that price is going to continue this way or go back this way, and then you're going to lose all this wonderful profit that you made. What you could do is, let's say that you're worried because of the market conditions. It looks like it's just going to keep on running and going that way. You could gamma hedge and put on a synthetic long position that starts right in the middle here, and essentially it's a call and a put, where you would go short the put, long the call, same strike, but you would do it in an asset type that would be much smaller than the one that made up the fly. So let's say that the fly was made up of SPX. You could make the hedge with XSP. You could also make it up with long SPY. And that would gamma hedge. What it would essentially do is take the right leg and make it shaped like that. And then your profit curve would be shaped like that. So that if you went that way, you're hedging the move going in this direction with either the synthetic long or an actual long using stock. And if you had enough profit and it started to go that direction, you could hedge the other side too. And then what that would do is literally lift the fly up like this so that you would have a guaranteed profit and the chance that it could land up in the fly as well. It doesn't matter if you're choosing a different underlying. It's all the same. It's all your account, so who cares? You can, you should be able to look at a combined profit curve. Well, you can do that in Thinkorswim. A lot of other platforms don't allow you to do it, but there are some tools that let you see a combined profit profit curve from multiple positions. So it would all work the same. All right. So there we examined a number of different things. Now you can do the same gamma hedging in an iron Condor as well. I just chose not to look at that right now. So we covered the strategy life cycle. What we're going to do, we're going to pick a number of strategies that we're going to monitor from different categories. All of them are going to be discretionary strategies that run on 0 DTE. There would be premium collection. There will be variants of various strategies that I talked about before. There are strategies like the straddle and the strangle. We can look at a strategy called the straddle strangle swap. We can look at calendar spreads, diagonals, iron condors, butterflies, gamma hedging, all of that. And we'll create a number of them and then start running them. The iron fly is no different than the fly. So I don't see any material difference between the two. I'd rather put the long fly on than the iron fly. The iron fly is just more complex, but it gives you exactly the same risk, the same profit potential, same strikes. Everything about it is exactly the same, except that it's more complex. So we'll do the regular fly instead. All right. So that's about it. If you guys have any questions, I'll wait to see. Let's see. Are you dynamically adjusting? With the dynamic hedge, yeah, that would be a dynamic strategy, but that's the only strategy right now. You can make the argument that a gamma hedge is also a dynamically adjusted trade as well. All right, so that's it. If you like this this content, please give this video a thumbs up. Please thumbs up and subscribe to this content and click that notification bell so you can be apprised every time we come out. We'll be here every day from 3 to 4, Monday through Friday. All right. Thank you very much. Peace to you all. Oh, we got to bring back the big head. And again, if you want to join the service, go down below, 4-week trial. Peace to you all. Take care. More music.